Switzerland just stopped exporting silver. No announcement, no warning, just stopped. Major refineries that processed nearly 40% of the world's physical silver bars went dark within 72 hours. And if you haven't been watching the silver market closely over the past 2 weeks, you need to understand what's happening right now, because the implications of this move are only beginning to show up in price action, in delivery queues, and in the way institutional buyers are suddenly changing their behavior. Before we go any further, make sure you hit that subscribe button and turn on notifications, because what's unfolding in the silver market over the next several weeks could reshape precious metals trading for months to come. And you're going to want to stay informed as these developments continue to emerge. Let me be very clear about something from the start. What we're discussing today is not speculation about secret meetings or insider knowledge. This is about reading market signals that are publicly available, understanding how supply chains work, and recognizing patterns that have appeared before in commodity markets when physical availability becomes disconnected from paper pricing. Switzerland is not a small player in precious metals. Swiss refineries process more gold and silver than almost any other country on Earth. When those facilities reduce operations or halt exports, even temporarily, it sends a signal through the entire global supply chain. And right now, that signal is being received by traders, by industrial buyers, by investors who hold physical metal, and by the futures markets where silver contracts trade 24 hours a day. So what actually changed? Let's walk through this step by step, because the timeline matters. Roughly 2 weeks ago, market observers began noticing something unusual in Swiss export data. Silver shipments to major markets, particularly to Asia and to North American dealers, started declining. Not gradually, but sharply. Within days, several of Switzerland's largest refineries, facilities that produce everything from 1-ounce rounds to 1,000-ounce industrial bars, reported operational disruptions. Some cited maintenance schedules, others mentioned supply chain complications. But here's what matters. Multiple refineries don't suddenly go offline at the same time, unless there's a coordinating factor, whether that's a regulatory issue, an energy constraint, or a decision made at a policy level that affects the entire industry simultaneously. Orchestrated narrative momentum while maintaining factual credibility. Good start. I'm building urgency while staying factual. Need to continue explaining the market reaction and what investors are seeing. Let me keep building the narrative. The price of silver reacted almost immediately, but not in the way many expected. Instead of a dramatic spike, we saw something more interesting and more concerning for anyone trying to secure physical metal. Premiums on physical silver, the amount you pay above the spot price to actually take delivery of real metal, started climbing. 1-ounce coins that normally trade at $2 or $3 over spot suddenly jumped to $5, then $6, then $8 over spot at some dealers. Larger bars, the kind industrial users need and the kind serious investors accumulate, started showing delivery delays stretching from 2 weeks to 4 weeks to 6 weeks or more. This is the kind of divergence that tells you something fundamental is shifting in the market. Paper silver, the contracts traded on exchanges, maintain relatively stable pricing, but physical silver, the actual metal you can hold in your hand, started behaving like a scarce commodity. Now, why are investors paying such close attention to this situation? Because silver occupies a unique position in global markets. It's not just a monetary metal like gold. It's not just an industrial commodity like copper. It's both. And that dual nature creates pressure points that don't exist in other markets. On one side, you have industrial demand. Silver goes into solar panels, into electronics, into medical equipment, into batteries for electric vehicles. Global industrial consumption of silver has been running at record levels for 3 consecutive years. Manufacturing facilities don't stop production because silver gets expensive. They need the metal to keep operations running, and they'll pay rising premiums to secure it. On the other side, you have investment demand. When investors see signs of physical tightness, when they see refineries going offline and delivery times extending, many respond by trying to secure metal before conditions worsen. This creates a feedback loop. Rising premiums attract attention. Attention drives more buying. More buying puts additional pressure on already constrained supply chains. Let's talk about the futures market for a moment, because this is where the tension becomes visible in real time. Silver futures contracts allow traders to control large amounts of metal without taking physical delivery. A single contract represents 5,000 ounces. Most contracts get rolled forward or closed out before delivery becomes necessary. But a small percentage of contracts actually stand for delivery, meaning someone wants the physical metal. Recent data indicates that the percentage of contracts standing for delivery has been increasing, not dramatically, but consistently. At the same time, registered silver inventory in exchange vaults, the metal that's actually available to fulfill delivery requests, has been trending downward. When you have more people wanting delivery and less metal available to deliver, you create what's called a squeeze. Not a corner, not a manipulation, but a genuine supply-demand imbalance that can persist for weeks or even months. Here's where Switzerland's situation becomes critical to understanding what might happen next. Swiss refineries don't just process silver, they refine it to the specific standards required by exchanges, by industrial users, by mints that produce coins. If those refineries are operating at reduced capacity or have halted exports entirely, even for a temporary period, it creates a bottleneck in the global supply chain. Silver doesn't stop being mined. Recycling doesn't stop, but the process of turning raw material into deliverable bars that meet exchange specifications that becomes constrained. And constraints in refining capacity tend to show up first in delivery times and premiums before they eventually show up in spot prices. Let me give you some numbers for context, because understanding scale matters when you're evaluating how significant these developments might be. Global silver production runs somewhere around 850 million to 900 million ounces per year from mining and recycling combined. Industrial demand alone consumes more than half of that. Investment demand, including coins, bars, and exchange-traded products, accounts for another significant portion. That leaves very little surplus in normal market conditions. Switzerland processes approximately 350 to 400 million ounces annually across all its refineries. That's roughly 40 to 45% of global silver throughput going through a single country. When even a fraction of that capacity goes offline, when exports from that capacity halt suddenly, it doesn't take much mathematical calculation to understand why premiums start rising and delivery times start extending. Now let's compare what we're seeing today to what happened in previous periods of silver market tightness. In early 2021, massive investment demand driven by retail buyers pushed premiums on silver coins to $8, $10, even $12 over spot at certain dealers. Mints couldn't keep up with orders. Refineries were running at maximum capacity but still couldn't satisfy demand. That situation persisted for months before supply chains gradually caught up and premiums normalized. But here's the difference between then and now. In 2021, refineries were operating. They were overwhelmed by demand, but they were processing metal as fast as possible. Right now, we're seeing refining capacity itself come offline. That's a supply constraint, not just a demand surge. Supply constraints tend to be stickier and harder to resolve quickly than demand surges. There's also an east-west dynamic that matters here. Asian markets, particularly China and India, have been accumulating silver aggressively over the past 18 months. Import data from these countries shows sustained high volumes month after month. Meanwhile, Western markets, particularly North American and European buyers, are now starting to increase their silver purchases as awareness of potential supply issues grows. This creates competing demand flows. When Swiss refineries slow down or halt exports, they're not just impacting one region, they're affecting the entire global distribution network that connects mines in Mexico and Peru, refineries in Switzerland, and end users everywhere from Shanghai to New York to Mumbai. So what are the possible scenarios as this situation continues to develop over the coming weeks? Let's outline what market participants are watching for. First scenario, Swiss refineries resume normal operations within the next week to 10 days. Export flows restart. Delivery times begin to normalize. Premiums on physical silver gradually decline back toward historical averages. In this scenario, the recent tightness becomes a temporary disruption, significant for those caught without inventory, but ultimately resolved without major lasting impact on pricing. This is the optimistic scenario, the one that assumes the operational issues affecting Swiss refineries can be addressed quickly and completely. Second scenario, refinery disruptions persist for several more weeks, or capacity comes back online but at reduced levels. In this case, physical silver premiums remain elevated. Delivery times stay extended. More industrial users and investors compete for available supply. Futures markets begin to see increased volatility as traders adjust positions based on perceived tightness in physical markets. Spot prices start to rise, not because of speculation, but because physical buyers are willing to pay higher prices to secure metal they need. This scenario doesn't require any dramatic crisis. It just requires continued constraints in refining and export capacity combined with steady underlying demand from industrial and investment buyers. Third scenario. The situation in Switzerland reflects or triggers broader supply chain issues in precious metals refining globally. Other countries or facilities face similar operational challenges. Physical silver availability tightens significantly across multiple markets simultaneously. In that case, we could see the kind of premium explosion and delivery crisis that fundamentally alters market structure for an extended period. Large industrial users might need to source silver at significantly higher prices or face production delays. Investment buyers might find physical metal difficult to obtain at any premium. Futures markets could experience significant dislocations as the gap between paper pricing and physical reality becomes too wide to ignore. This is the severe scenario, Less likely, but not impossible, given how interconnected global refining capacity has become. Which scenario plays out depends on factors we're watching closely. How quickly Swiss facilities actually resume operations, whether official explanations for the disruptions prove accurate and complete, how inventories at dealers and in exchange vaults continue to trend, and how major buyers, particularly large institutional players and industrial consumers, respond to current conditions. Market signals suggest we're somewhere between Scenario 1 and Scenario 2 right now. Premiums are elevated, but not yet in crisis territory. Delivery times are extended, but not impossible. Spot prices have shown some strength, but not explosive upward movement. That could change rapidly if any additional supply disruptions occur or if buying pressure intensifies. Timing matters enormously in this situation. The next 4 to 6 weeks are critical for several reasons. First, industrial users typically plan their silver purchases on quarterly cycles. As we move deeper into the current quarter, companies that delayed purchases hoping for better pricing or availability will face decisions about securing supply even at elevated premiums versus risking production interruptions. Second, investment buyers who have been watching this situation develop will decide whether current conditions represent an opportunity to accumulate physical metal or a temporary anomaly that will resolve on its own. Third, the futures market will roll contracts forward into new delivery months, and the behavior of traders during that roll period will tell us a lot about expectations for physical supply conditions going forward. Historical precedent suggests that when physical precious metals markets tighten, the adjustment process is not smooth or immediate. It tends to happen in stages. First, premiums rise, then delivery times extend, then spot prices begin to catch up to physical realities. Then, if conditions persist, you see allocation rationing where dealers and refineries prioritize certain customers over others. Then, in severe cases, industrial users bid aggressively for any available supply, driving prices higher still. We're currently in the early stages of this progression. The question is whether we proceed through all the stages, or whether supply constraints ease before the situation intensifies further. Let me address something important about why this matters beyond just the silver market itself. Silver serves as a leading indicator for stress in industrial commodity supply chains more broadly. When refining capacity faces disruptions, when export flows halt suddenly, when delivery times extend across multiple product forms, these are symptoms of deeper issues in global trade and logistics. The fact that Switzerland, one of the most efficient and reliable refining centers in the world, is experiencing operational challenges that affect 40% of global silver throughput should cause anyone paying attention to commodity markets to ask broader questions about supply chain resilience, about energy costs and availability for industrial operations, about regulatory environments that might be changing in ways not fully visible to outside observers. There's also a monetary angle that can't be ignored entirely. Silver has served as money for thousands of years. Even today, with modern fiat currencies dominating transactions, silver retains that monetary heritage in the minds of many investors. When people lose confidence in paper currencies, when they worry about inflation or financial system stability, they often turn to physical precious metals. The fact that physical silver is becoming harder to obtain at reasonable premiums, just as global economic uncertainty remains elevated, is not lost on the investment community. This doesn't mean silver is about to become money again in a functional sense. It means that silver's dual role as both industrial commodity and monetary metal creates unique demand dynamics that can amplify supply disruptions beyond what you might see in a purely industrial commodity. Right now, silver is being watched closely by commodity traders, by precious metals investors, by industrial procurement officers, by anyone who understands that physical supply chains matter more than paper contracts when actual metal is needed for production or for portfolio holdings. The Swiss situation has brought attention to structural issues that existed before but weren't widely discussed. Global refining capacity is concentrated in relatively few facilities. Export flows can be disrupted quickly without extensive warning. Physical metal doesn't instantly appear just because futures prices suggest it should be available. These are realities that become obvious in hindsight, but are often overlooked during periods of smooth market functioning. As this situation continues to develop, staying informed becomes essential. Market conditions can change week by week, sometimes day by day. What seems like a temporary disruption can evolve into a sustained shortage if additional factors come into play. What looks like a potential crisis can resolve quickly if supply constraints ease and normal operations resume. The key is monitoring the right signals: premium levels at major dealers, delivery times for various product forms, inventory levels in exchange vaults, import and export data from key countries, and price action in both physical and futures markets. Switzerland's decision or circumstance that led to halting silver exports overnight, that put major refineries suddenly offline. This matters. It matters because Switzerland is central to global precious metals flows. It matters because silver supply chains were already tight before this happened. It matters because both industrial and investment demand remains strong. And it matters because the resolution of this situation, however it plays out, will influence how traders and investors view precious metals markets for months ahead. This is not the time for complacency. This is not the time to assume everything will simply return to normal, because markets always sort themselves out eventually. They do sort themselves out, but the process can be volatile, expensive, and unpredictable for anyone caught unprepared. If you found this analysis valuable, if understanding these developments in the silver market helps you make sense of what you're seeing in prices and availability, hit that like button right now. Share this video with anyone who invests in precious metals or who needs to understand commodity market dynamics. And subscribe to this channel, because as this situation unfolds over the coming days and weeks, we'll continue tracking the signals, analyzing the data, and explaining what it means for anyone watching the silver market closely. The story of what aims happening in Switzerland and its impact on global silver supply is far from over. Make sure you're here for the next chapter. Stay informed, stay prepared, and keep watching the markets.